There we go. Let's get going. Fantastic. Well, thank you so much for joining us. Really excited to be talking about carbon pricing. Um, just before we get into this, carbon pricing, in my view, is a combination of one of the uh, most sort of talked about topics that I find in conversations with sustainability professionals, while also being one of the least understood when it comes to how to derive one, how to use one, and what one even means. In our team, we have a perspective, but we also wanted to see what was out there. So we started doing some research, and we actually found that there was very little consensus on what the right approach is. So we figured, let's put our approach out there because it makes sense to us, makes sense to most of our customers, and it might at least be one frame of reference for those of you who are thinking about how to incorporate carbon pricing into your sustainability toolkit. Before I kind of launch into things, let me just maybe introduce myself and invite Ilya, my co-presenter, to introduce himself as well. So I'm Saif. I'm the founder and CEO of Altruistic. Some of you may be following our podcast already, State of Sustainability, or our newsletter. For those that are, you probably already know more about me than most of my friends who don't follow our podcast or newsletter. But for others, let me happily introduce myself. So I've been in the sustainability space for about 20 years. I started off on the nonprofit side, moved into the public sector space, then joined McKinsey, did almost a decade at McKinsey, lots of slides, lots of spreadsheets, lots of analysis. I'm sorry if at some point I stepped on toes that were near to you. I got bored of McKinsey about halfway through, so I started a farming business, as one does while at McKinsey. My farming business was growing roses and jasmine and supplying into the fragrance and cosmetics industry, and I moved into the essential oil part of that as well. And at some point, I started finding that my customers, my B2B customers, were looking to me to pitch innovation. They actively wanted me to come with innovations for how I could improve the environmental impact of the products I was selling them, whether it was changing farm practices or incorporating new technologies. And they wanted me to illustrate the impact that this could have for their business as well. And so that first started getting me exposed to carbon pricing. I also was playing around with marginal abatement cost curves, as one does, and in my consulting work, and I found that they were helpful, but at the same time not fit for purpose. So this webinar incorporates some of those learnings as well. Let me ask Ilya to introduce himself, and then happy to tell you a bit more about Altruistic as well, just before we get started. Ilya, over to you.
Thanks, Saif. Great to meet everyone who I haven't met before, and welcome back to our regular joiners who tune into these webinars and podcasts as well. I'm Ilya. I'm the lead solution architect at Altruistic. My favorite thing is solving various sustainability data challenges, and that's what I specialize in at Altruistic. I work across the consumer goods space and have seen the good, the bad, and the ugly of sustainability data in that time. And really looking forward to deep diving on carbon pricing specifically today, and hopefully busting some myths, as Saif was mentioning, and helping answer some practical questions and get you guys set up to really take advantage of this tool internally.
All of that is true except for the first part. Ilya's actual favorite thing is running, but this might be a close second. Maybe to move on and provide a word from our sponsor, which is Altruistic. So we're a software company. We typically focus on unifying environmental data in one place and then supporting various use cases on top of that, which might be environmental accounting, scope 1, 2, 3, increasingly water, waste, etc., supporting target setting, scenario modeling, initiative creation, generating product carbon footprints at scale, and then supporting with supply chain engagement and collaboration. So carbon pricing for us is very much a use case that we see our customers and users incorporating into their use of the platform, and we're increasingly building to support incorporating carbon pricing into day-to-day decision-making, just to sort of ground us in context. What we're going to talk about is a 4-step approach that we're taking towards how you set carbon pricing. But in the context of a broader agenda, I'm just going to start with a very small dose of myth busting, and then move into each of the 4 steps. We'll also loop Ilya back in around halfway through, just to give you a very mini demonstration of just practical kind of uses of carbon pricing as well. And then ideally, we round this out at about the 30-minute mark, 35-minute mark, and we can still leave 10 or 15 minutes for Q&A rather than boring everyone with a very long webinar. If you do have questions, please either put them in the chat, and we'll come to them when we come to Q&A, or just write them down somewhere. You can message them, you can sort of message them to me directly in the chat or put them in the group chat, depending whether you want others to see your question or not. And looking forward to getting into some of those as well. Maybe just to start off with myth busting, I have noticed a lot of the carbon prices that I see reflected in CDP submissions tend to be nice round numbers, $50, $60, $70, these sorts of things. And my expectation and assumption is that in most cases, these numbers are basically high level derived from Paris Agreement-based benchmarks. And so at some point after the Paris Agreement, we started seeing these sort of ranges of around 50 to 75, 50 to $80 per ton as a general kind of carbon price that would make sense for everyone to apply to try and get the world towards Paris Agreement goals. In my view, that is useful as a conceptual device globally. It is not super practical in a business context internally and in how you engage with your business stakeholders in your company. And so we're going to try and talk in very practical steps about how you actually cost carbon in the business. And in many ways, the approach that we're taking would be better described as carbon costing, because fundamentally we see carbon as a liability for the business. It is not something that you want to buy. It is something that you are acquiring either by virtue of stuff that you're buying, it's embedded in the products that you're buying, or it is generated as a byproduct of an activity that you're doing in the business. It is a liability, it is a cost, and you want to think about how you can actually account for that cost and ultimately reduce that cost for the business. Hopefully that is a more practical way of approaching it, but it amounts really to the same thing in terms of reporting and how you would use this. Let me maybe get into step one, which is around internal buy-in. As with most things in sustainability, you want to both start and end with buy-in, actually. And so there are three types of stakeholders that we consider to be important when it comes to thinking through your carbon pricing approach. Typically, finance, procurement, and the exec team, whether it's senior management or the board, are always going to be important stakeholders for any aspect of your sustainability strategy. I would also think about it almost in this sort of chronology. And so with carbon pricing, I would look to get the finance team engaged and involved early as a thought partner and a sparring partner for setting the carbon price. There are a couple of reasons for that. One is that the finance team will bring the quantitative rigor and expertise by virtue of their day jobs that you often don't find embedded within sustainability teams. Most sustainability teams that I've come across tend to be qualitatively skilled versus quantitatively skilled. So they index typically more heavily on great communication skills, big picture thinking, ability to drive alignment. They tend to struggle a bit more when it comes to hard-nosed quantification of the sort that is the bread and butter for financial controllers, chartered accountants, and others. That's changing a little. It might look different in a few years, but right now that's the lay of the land. Involving the finance team early gives you sparring partners for how to think about carbon pricing as a financial metric very similar to IRR and weighted average cost of capital, which are other metrics that finance teams will be used to using when it comes to thinking about budgets, investment, spending, etc. And so I would incorporate finance as a sparring partner, and I would then also try and get them bought in on helping you use carbon pricing as an approach in your budget conversations with them. So ideally, finance should recognize the numbers that you bring back to them maybe in several months' time for business cases and be able to reference business case A versus business case B and compare and contrast them on the basis of a carbon price logic. And that's the benefit of involving finance early. Procurement is going to be another important stakeholder that you want to align on the principle of carbon pricing and the logic of using this in practice for procurement decisions. In the best case, what you're building towards, and we'll come back to this a bit later, is you want procurement to actually blend their existing procurement indices with carbon pricing logic. So if procurement right now is solving for, let's say, price, volume, quality, timing, maybe a couple of the other variables, you want them to also incorporate environmental impact and, let's say, carbon liability into that matrix as they think about decision-making as well. CBAM, or the Carbon Border Adjustment Mechanism, is giving this a massive boost because actually CBAM is kind of forcing this kind of decision-making already. But I think involving procurement actively in this conversation is super helpful because what you want to avoid is that you end up with something as a device that procurement doesn't own and doesn't know how to incorporate. Right now, most procurement teams that are thinking about sustainability have sustainability as an add-on or an additional layer. So 25% of the weightage in an end decision might be ESG, whereas actually you want them to blend those two together and think about them side by side. The weighted average cost of capital and carbon almost of this decision that I'm making. On the exec side, you want management to be bought in with the idea that you are going to be using carbon pricing as a device to cost the targets, the scenarios, the program, the roadmap that you're building. So when management asks you, it's great that you've defined this roadmap, it's great that you've set ambitious targets, what is this going to cost us? What you want to be able to say is, we are going to be using a carbon pricing logic to come up with the cost of achieving our roadmap and achieving our targets. This is the logic that we're going to take. We're going to come back to you with the exact numbers, but we want you to be bought in with the idea of what we're going to be doing. And then we're going to come back to you with some hard numbers. And by the way, in this webinar, we're going to come to how you might do that. But I just want to preface who are the key stakeholders that you think about. Once you've got that buy-in, the next thing is to think about setting your carbon price. There may be other approaches out there. These are three that we find interesting and we see getting some traction. I have been somewhat presumptuous in kind of labeling one of them good, the other better, and the next one great. But really, there are probably shades and variations between these. Arguably, the first two are not super different in terms of one being better than the other, but let me talk through each of them briefly. A carbon tax proxy would be where you actually have a carbon tax in operation. It could be a national tax of the sort that you have in South Africa. It could be a cap and trade scheme of the sort that you have in the EU or in California. But there's basically a hard number of some sort that applies to a geography and or a sector. And you say to the business, to your business, this is basically money going out the door already. These are dollars that we have to spend already because of existing legislation. And what we're basically doing is we're trying to optimize the business to minimize these outflows. And so everything that we're going to be doing in terms of initiatives should be by reference to the price we're paying externally. So for example, I was working with a business in South Africa at some point. I don't know if this has changed, but the carbon tax that they were looking at was going to be around €7 per ton or thereabouts. And so the business was thinking to themselves, what is the cost of decarbonization in our business per ton with reference to this $7 number? There's a bunch of stuff that we can do that is cheaper than $7. And there's a bunch of stuff that is many times more expensive than $7. For the stuff that's cheaper, let's go ahead and do it. For the stuff that's many times more expensive, let's just pay the tax. I'm not saying that's the right approach to take. I'm just saying factually, that is the approach that this business was taking. And that's where you get to with a carbon tax logic. There are a couple of pluses and a couple of minuses to using a carbon tax logic. The benefit is that it's hard cash. It is money going out the business. It's factual. There's very little ambiguity about it. The downside is that it is usually geographically and or sectorally defined, which means that for global businesses, it might only apply in some jurisdictions, or it might only apply to some business units. And so it's not usually the best way to think about your holistic decarbonization challenge. The offset proxy is a little better for those of you that have large established offset programs, because you may, hopefully you have already, as part of those programs, done the thinking around what types of offsets you're going for, what magnitude you're going for, how you're sourcing them, et cetera, which means that you have some sort of a benchmark. Whether you're going for something like nature-based solutions and you're spending, I don't know, $7, $8, $9, $10, $15 per ton, or you're going for something fancier like direct air capture and you're spending the hundreds of dollars per ton, or a blend or a mix or whatever it is, you have some sort of threshold of cash that the business has committed to spending as a way to offset their emissions. And you can then say, look, actually, if we reduce the emissions, potentially we can reduce the amount that we might be spending on offsets. So it becomes another reference point. The reason I say it's slightly better is because it is usually more holistic, more global in nature, less sector-oriented and more oriented around the business. But frankly, between the first and the second, I think you're sort of on the margins either way. The third approach, which, spoiler alert, is the approach that we think generally makes the most sense, is the marginal abatement curve, cost curve logic. And in this logic, just to maybe talk a little through how it sort of plays out, you basically look at 4 different steps. And so the first step is you think about what are the different activities that are generating emissions within my business. Ideally, you also look at sub-activities. So you're saying, let's say logistics, maybe that's the activity. There are sub-activities within logistics. There's my last mile, there's upstream, there's other stuff happening within the logistics world. You can actually take the logic as far down as you want to or are able to in terms of actually drilling into sub-activities. You then want to sort of map against all of those sub-activities. You want to map two things. One is the emissions associated with that sub-activity, and the second is the initiatives that might target that sub-activity. So let's go with, for example, downstream last mile logistics. And let's say I'm doing parcel delivery and I'm trying to get parcels delivered to the consumer home. And within that, I have two sort of initiatives that I could be targeting for that particular sub-activity. One is I could be targeting increasing the size of the parcel that's being delivered. So I'm doing larger kind of parcel sets and doing drop-offs. The second might be I'm electrifying the vehicle type that is doing that last mile delivery. Those are two initiatives, both targeting the same sub-activity. Both of those initiatives have a different quantum of emissions for that sub-activity that they can capture. And both of them have a different cost. So let's say I have 100 tons of emissions being generated by this last mile delivery. And let's say that I assume that I can actually reduce 20 tons of those 100 by changing the parcel format. And I can reduce 80 tons, for the sake of argument, 80 tons by electrifying the last mile delivery. And the cost for the 20 tons is $1 per ton, and the cost for the 80 tons is $2 per ton. I then get about $180 as the cost of decarbonizing that sub-activity based on a weighted average across those two initiatives. I hope my math checks out. I was doing it in mid-sentence, but roughly that's kind of the logic that you would take to estimate these numbers. And you sort of then calculate the same thing across all of the different sub-activities and all the initiatives that you're considering. It does not need to be perfect. And I want to emphasize this. What you would be doing here is already probably for most businesses several steps beyond the high-level road mapping exercise that most companies are doing. It is already super useful, even if you have very high-level ballpark estimates on the sub-activity mapping, on the initiatives, on the costing, but it gives you already a very strong sense of direction on which initiatives are likely to cost more and which initiatives can target the biggest share of the pie. If you think about how this, let's say, used to look back in the old days, and this is the sort of stuff that I was doing as a consultant, we were making these marginal abatement cost curves. These first, you don't need to pay super close attention to the chart for those of you that have your eyes hurting a bit right now. I'm just going to talk through this at a very high level. These were helpful in the early 2000s when they first started coming out. And they first started coming out as a way for humanity as a whole to come to terms with the cost of some sort of global decarbonization, whether it was 4 degrees or 3 degrees or whatever, and to say, look, actually, this problem is solvable globally. And so the idea was, let's actually take all the initiatives for decarbonizing all the biggest heavy emitting industries in the world or national budgets. Let's put them on a cost curve. And the logic of this cost curve that you see is more or less exactly the same as what I've described. It's just about how you present it. And how you present it here is that you have an x-axis and a y-axis. On the x-axis, typically the width of the column, each column represents one initiative. So think of that electrification of transport. That's one column. And the width of the column on the x-axis is how much of the emissions problem can you address. And let's say the length of the column, whether it's below the line or above the line, is the cost. Typically, if it's below the line, that means it actually makes you money. If it's above the line, that means you're spending money. And so you arrange it from cheapest to most expensive. Some initiatives may get you massive bang for your buck. So think of that 80-ton example I gave on electrification of transport. That was a bigger volume of initiative versus the packaging example that I shared. So that would be a fatter or wider column, and it's also more expensive. So maybe it's a longer column as well. This logic was helpful, I think, for sectors, and it was helpful for geographies. I, in practice, found it very difficult to apply to business clients of mine as a consultant. And the reason is I stumbled into two problems. One is companies that had multiple business units in very different fields, where each business unit actually had just very different sorts of activities, with very different sorts of initiatives required. And getting all that into one chart was very fiddly, very difficult. So you start to have 2 or 3 different charts that you were creating for a single global business. The second problem I would face is that to update these charts were always one point in time. It was my emissions today, the initiatives that seem viable today, the cost per initiative today, and various other today assumptions. Whereas actually this chart, I mean, this snapshot we have is already like a very old chart, about maybe 15, 16 years old. And this probably looks completely different if you were to rerun it today. So very quickly, I was in the zone where I was creating maybe 2 or 3 charts for different business units in a company, and maybe 2 or 3 more charts for each of those for different points in time. I was saying, this is what I think it's going to be this year. This is what I think it's going to be in 5 years. This is what I think it's going to be in 10 years. That's just very clunky and very difficult and doesn't really support all the use cases that we were talking about, where you want to be able to incorporate this into procurement models, into budgetary discussions with finance. You don't want to have to go in and engage a McKinsey or a BCG or a Bain every 6 months or every year to kind of rehash this for you. And so what we did was we kind of took the same logic and we tried to make it more dynamic. I'm not saying this is something that only we can do, but I want to maybe just bring Ilya in now to show you what it looks like, to give you just a reference case for how you might be able to set it up for yourselves as well. Ilya, over to you.
Thanks so much, Saif. So this is just an example of how we look at it. And as Saif said, we're not the only ones who do this, and there are a variety of different approaches. But to Saif's point of making this a dynamic view that you can use very actively in decision making, and also use to track your actual initiatives and interventions that you're making, not just as a snapshot in time, which you bring in consultants to do on a one-off basis. So this is an altruistic platform. There's, of course, a number of different things the platform does, as Saif mentioned, but we're right here in the corporate initiatives section, and we're looking at a fictional company, Foodco PLC, which has modeled 6 different interventions that it can take. And what you can see is already some summary statistics on these interventions, such as how many tons of CO2 equivalent does each intervention save, what time period of intervention is this, and then also what is the status. So some of these are already in flight, some of these are still being modeled. And crucially, here you see the cost per ton of CO2e, which allows you to compare these different initiatives. So how is that calculated? Well, if I go into maybe a couple of straightforward examples, let's start maybe with this one, which is switching to 70% on-site solar energy, let's say in a particular facility or in a group of facilities. So how does this work? Well, here I can create a scenario which allows me to first of all model the growth of my business. So over the next few years, I expect my business will grow, and therefore naturally I might need more energy, for example, and therefore my emissions will grow by default. However, there are specific interventions that I can take, and one of them, the one being modeled here, is the switch from grid energy purchases to maybe installing some on-site photovoltaic solar energy. And what you can do is actually model a specific pathway of what does that transition look like in terms of kilowatt hours used from your total usage today, which is all being bought from the grid, to gradually transitioning away from that, even as your total demand increases, to photovoltaic solar energy. And the critical piece is that you can then also add here the CapEx and OpEx cost associated with that initiative, whether that's kind of a higher upfront investment or whatever the ongoing cost may be. And the great thing with initiatives actually like energy, I mean, here, just for the sake of example, I've put it as a positive cost, but you will often find, and what we often see with the companies that we work with, is that this can actually be a negative cost in the sense that you're saving money by making such a transition, for example, to renewable energy or on-site energy. But for the sake of argument, let's say this is a positive cost for now. And what this then allows you to do is automatically calculate, using a net present value formula, what is that cost per ton of CO2e. And there's a couple of different ways of calculating it. There is a simple from to comparison. So what has been the emissions reduction in terms of tons from your starting year, and therefore what is the cost per ton of CO2e. There's also a way of looking at it cumulatively, which is over the course of this 5 or 7 year period that we're looking at. What is that cost per ton of CO2e? And then as you see, it comes out as a lower number just because we're looking at a cumulative reduction there. And then that's what Saif was saying. There's different logical steps that you can take to define how you look at carbon pricing and costing within your business. And there's always that flexibility, but the important element is to keep it dynamic so that it reflects what is actually happening in your business and can continuously update on that basis. And if I go back now into this view, what you can see here again is all those different initiatives for different areas. So maybe there's something to do with products and packaging, something to do with utilities, something to do with logistics, as Saif was saying there. And even when initiatives are very different in absolute size and absolute cost, so you might have huge initiatives which generate massive savings, you can actually compare them still on that cost per ton of CO2e basis, which can be a much more helpful tool in your decision making and in building those internal business cases as well.
Thanks, Ilya. Super helpful. I'm gonna jump back in now. We're kind of doing this fun tag teaming. We've talked a little bit about how you sort of set your carbon price. Let's talk a bit more about how you use your carbon price. We think that there are three ways that you could use it, some similarities between some of them, but broadly speaking, you can think about shadow pricing, which is where you treat this carbon price as a hypothetical construct, and you're using it as a reference case. So you get, let's say, a new initiative pitched by someone in the business, you get an initiative pitched by a supplier, and you're able to actually say, well, how does this compare against my general average carbon price? So for example, you create all of those initiatives for all of the sub-activities, you add a price for each of those initiatives, you do the weighted average calculation, and you say, well, my average carbon cost across the business, my carbon price across the business is $27.53 per ton. And actually, I'm getting initiatives that are at $3 per ton. This competes very effectively versus my 27. If I look at it at a sub-activity level, the sub-activity that it's targeting, it's still cheaper than the number I have there. So overall, deploying this new initiative that's being pitched to me as a stakeholder in the sustainability team or the finance team, this new initiative actually looks like it's in the money, let's go for it, versus something that looks prohibitively expensive. The next level on, cost integration, is where you're actually trying to integrate these numbers in a more dynamic way into actual decision-making tools that you already use in the business. So this might be incorporating them into, for example, how finance makes budgetary allocation decisions. It might be incorporating it into procurement decisions, a procurement index. And for that purpose, you're trying to get something that is a little more dynamic, a little more live, a little more granular, so that it can be incorporated into, let's say, individual purchase choices, individual procurement processes, for instance. And then the third level, which you could probably do as an add-on onto the cost integration, is if you start approaching your carbon price as effectively an internal carbon tax, where you say, well, actually, I'm kind of charging my business stakeholders, whether it's functions or business units, for any carbon that they are bringing into the business, whether they're acquiring it through procurement activities or whether they're generating it through other business activities. And I actually want to treat that as a tax or a fine almost internally, and that's going to be used to finance parts of my sustainability program. I have not seen huge numbers of examples of that happening. I think Microsoft is one of the more famous ones. I think Microsoft is in many ways a unique sort of business where that makes sense. And it's particularly being applied to travel-related emissions to start with, I believe. But that's also an approach that I think is interesting. If we sort of move on, maybe, and I'm sort of conscious of time as well, so I want to move towards Q&A. But if we think about, let's say, how a B2B business, business selling to other companies, or a B2C business, one selling to end consumers, might incorporate carbon pricing as a device into practical business. The first use case is, of course, common to both, which is let's use carbon pricing as a way to differentiate between initiative A and initiative B that we want to pursue within our business. The other logics, I think, are also quite interesting, which is if you're B2B, increasingly we find that the most effective sustainability leaders in B2B are pitching innovations to customers. For those of you who were here at the start of the webinar and heard my introduction, as a supplier into the fragrance industry, a supplier into the cosmetics industry, I was being invited to pitch innovation and give some rationale for why this made sense for my customers for their problem. I was actually hosting a podcast with Patrick, who leads the sustainable packaging team at Mondelez, the snack food brand. It'll be coming out in the next week or two. And there, what Patrick was talking about was multiple sorts of innovations that they were collaborating on with their suppliers. And actually, his guidance to B2B companies was think about the holistic problem that you're solving for your customer and pitch it with reference to that. And so I would encourage all B2B companies to start thinking about if you're let's say you're selling a particular ingredient or material, you now want to pitch an alternative. Think about the emissions reduction you're achieving with the alternative for your customer. Think about the cost of that on a per ton basis and pitch that cost to them. And so what you're saying is we are actually pitching you an ingredient, but this ingredient represents a $5 per ton cost of emissions reduction. on the basis of the price we're charging you versus alternatives. And that $5 per ton, we believe, is attractive versus any other opportunities you have in a similar space. That is the way, at least, that I would think about this in a B2B context. In a B2C context, I think that there's some variations on how you do this. I actually think that air travel is probably one of the most advanced on this. Many of you who have bought airline tickets recently will have noticed the option to offset the emissions of your travel. And that, in my view, is basically the airline passing on a carbon cost to the consumer. They're basically saying we're going to be offsetting or buying sustainable air fuel or whatever we might be doing, and we're incorporating that into a per purchase price for the consumer and passing it on and giving the consumer the opportunity to pay for that. I think that's a really interesting use case for hospitality as a sector overall, hospitality and travel. And I expect to see a bit more of that sort of thing also coming out in the more direct consumer CPG space as well, where I think there's a lot of potential for that. Let me maybe talk briefly, having touched on how you use your carbon price, let me talk briefly about tracking and monitoring. Ilya touched a little on the sort of dynamism of how you might be doing this. I think that there is a healthy frequency and many unhealthy frequencies. I would probably not look to refresh your carbon price less frequently than every 2 years. The reason I say that is because a lot of these numbers will be outdated. Your emissions numbers will change for sure. The initiatives that you apply may change, and the cost of those initiatives will definitely change, in many cases for the better, in some cases for the worse. And so I think beyond 2 years as a frequency is unhealthy. I also think there's no need to do this, frankly, quarterly or anything more frequently than quarterly. I feel like annual is probably the sweet spot of where to land, the Goldilocks zone. And so I would think if you are doing a light touch refresh every year, where you're basically keeping the same structure, the same scaffolding, and you're basically just incorporating new inputs, which are the new emissions numbers based on your latest data, and maybe a refresh of the cost to decarbonize, where you're really just sense checking whether the numbers have changed radically. And you can do this, frankly, by asking vendors, asking your logistics partner, asking your energy partner what a cost would be to decarbonize that particular activity, and using that as the basis to refresh some of these numbers. With that, I'm actually going to pause there and open it up to questions. But just before I do, I kind of want to also say if this sort of content is interesting for you, we have a guide that we published on this as well. So please feel free to check it out. It has a lot of this in a format that you can share around internally if useful. And then, of course, feel free to tune into our podcast where we have an episode also on setting up and using carbon pricing in case you want a different format for the similar content. With that, let me pause and go over to questions. Ooh, fantastic.
Great. Maybe just looking in the chat, I think we've got a few in the group chat and also some in direct messages as well. But maybe to tackle them sequentially, I think, Saif, the first question we have is how or when is a carbon price most defensible?
This is a good question. And I think there's a couple of sub-questions, which is effective for whom? And so let me give a few examples. The EU cap and trade scheme is effectively one approach to that, which is here's a price for carbon, here's a quota, and if you exceed the quota, you kind of have to pay an amount to get a credit. That scheme has been in some ways very effective, also in some ways quite outdated, and is due for a refresh. And so those prices are in many ways no longer reflective, but they provide an interesting insight into expectations. So when I first started seeing ETS prices rocket from like $15, $20 to $70, $80, $90, I don't know where it is today, you can see that there's an expectation that decarbonization is going to become a bigger thing, and that there's going to be even more movement towards this and even tighter regulation. The Californian equivalent is also, I think, considered to be a very effective kind of, or just a program that hit mainstream quite successful. At one point, I believe the majority of Tesla's profits were actually derived from renewable energy certificates, or the sort of certificate equivalent that they were able to trade by virtue of excelling versus that regime. I think that at a geographic level, I don't see non-tax related carbon pricing approaches gathering traction. I would expect to see much more industry coordination. So I think that the oil and gas industry is likely going to end up coalescing around a standard approach to how to price this. BP and Shell, for example, have been some of the most sophisticated companies in their approach. Very happy to talk about that offline as well, if at some point it's helpful. And then Catherine, yeah, very nicely summarized. The approach that we're suggesting to carbon price is effectively a weighted average calculation based on the cost of decarbonizing different parts of the business or different activities. I think that this is the most factually and quantitatively defensible approach, because it is literally, this is the actual price or the actual amount that I would have to pay to take carbon out of my business. And so, I feel like that is the most robust, most defensible way. There may or may not be more guidance coming out. I actually feel that any guidance that might come out in a industry-wide, geography-wide approach is still likely to miss a lot of business specificity. And I believe that taking the actual average cost of decarbonizing your business is the most subjective, most you-centric, most your business-centric approach that you could be taking. Luke, often we're analyzing the carbon impact of in-flight sustainability programs. It would be good to understand the benefit of first mapping impact areas before assessing interventions. Yeah, I entirely agree. And so I would think of the impact areas as partially overlapping with the sub-activities I was talking about. So you might, for example, say, look, actually our retail footprint, Luke, in your case, obviously retail footprint will be interesting, but also certain types of sourcing will be interesting. So you might say, and Luke is from John Lewis Partners and Waitrose. Luke, you might kind of say, well, we're buying a lot of cocoa, we're buying a lot of agricultural raw materials. Those are all subcategories of our purchases, and we're going to target each of these. And so there's actually a different set of things we might be doing for each of these. Those things that you might be doing are the initiatives in the model that I'm describing. So I would take the scaffolding and customize it to your needs, if that makes sense. And then Beth, I would say that a carbon cost price being used in the food and drink sector would work very similarly to what I'm describing. Just fresh from having talked about Waitrose, let me give a really interesting parallel that I see happening in the fair wage space. So Tony's Chocolonely, a chocolate brand that many people in our company love, including me, has sort of created a platform or a framework for how companies should buy cocoa in a way that distributes wages fairly across the ecosystem, and it's called the Tony's Open Chain. And so they invite other brands and other chocolate companies to be part of that platform and part of that framework, and also buy using the same standards. Waitrose was actually in the news recently around having passed on an element of that price to the consumer of chocolate bars sold. And the sort of the bar sold and through the bar that incorporated fair wage practices was more expensive than alternatives, and they were transparent about that. That is effectively a price being passed on. And I think the same logic could be true for regenerative agriculture, for example. You could say we're incorporating a regenerative approach to sourcing cocoa. It costs more. There's an additional price here, but you know what the price is for. And the consumer can pick that versus the alternative. And you might have two products, for example, under the same brand with that slight variation. Catherine, very good question. How do you calculate carbon price for a project that involves both CapEx and OpEx? And does the guide include worked examples for this? I actually think the guide does include worked examples. Let me also just summarize. I would take a net present value approach. And so when you take a net present value approach, for anyone not familiar with it, let's forget sustainability for a moment and just imagine it's a business case for buying a new tractor, for example. What you want to see is, what is the net present value for buying a new tractor? I'm going to look at the CapEx that I'm spending, the cost of the tractor, and I'm going to look at any OpEx costs that I have year on year, so maintaining the tractor, and I'm maybe going to look at the alternative costs that I would have had otherwise. So what is the cost that I'm saving? I no longer have to have, a person running around with a whatever it is, a scythe or whatever people would use in place of tractors. And so you actually kind of take all of those, the outflow of cash today and the outflows versus inflows or opportunity of cash every year, and you normalize that to year one by using a discount rate, and the discount rate will be different for every business. Happy to talk more about what I'm describing. Also, anyone kind of in the finance team in your business will also recognize this immediately. But you sort of normalize it to year one. That gives you an apples to apples comparison for the cost, where you're factoring in the CapEx on year one and all the OpEx in the future, and you're normalizing it to year one. Fabio, for B2B pitches, do we see in our experience suppliers adding markup to cost of carbon reduction to turn decarbonization from cost sharing into profitable activities and thus more attractive? Yes, we are seeing increasing signals of this. I actually suggest you also tune into the podcast episode with Mondelez that I mentioned, which will be out soon, because I asked Patrick specifically how he would advise companies to pitch this to him and how he sees this playing out and why it doesn't play out. And because Patrick leads packaging, packaging is one of those areas where you're often facing this question of whether there's a green premium that packaging suppliers can benefit from. And the logic we're seeing is that in general, it makes sense to start incorporating this into your pitches. You can have the dirty version or the business as usual version of the product and the cleaner version and what it will cost. This makes particular sense if you haven't already spent the money to decarbonize and it's an anticipated expense. You are going to be doing this in the future. You will only do it if there's co-investment from the customer. And so you want the customer to contribute. You want to make sure that you can pitch this conversation at the right level in the organization. That is often not your procurement counterpart. It may well be. There are a lot of fantastic procurement teams out there. It may otherwise be someone in a role like Patrick's at Mondelez, where he's leading sustainable packaging, and this is his problem to solve for packaging, and there'll be counterparts for other aspects. And then you also want to make sure that your expectations on time horizon are reasonable. So one of the insights from Patrick is it may not be a this year premium, but it will be a premium in 3 years. Because in 3 years, everyone's numbers start shaping up and everyone starts looking for these sorts of wins. And so we're seeing just a lot of momentum in that direction. Very happy to also give more information on this offline if helpful. And then Bruna, embedded emissions and byproduct emissions from the project, I would definitely consider. And so I think you want to, in the same way that you look at net present value as the sum of dollars going in and dollars going out, if the intervention that you're undertaking is also going to come with its own emissions element, then you want to definitely net those out as well. You want to take an actual netted out emissions contribution of this rather than just the overall reduction. You're replacing A with B, and so you should have the delta rather than the gross. And then Catherine asked for the guide, which we've shared. Luke, CBAM. Yes, I think CBAM is going to evolve in two directions. So CBAM right now, for those not familiar, the Carbon Border Adjustment Mechanism is being trialed, which means that right now companies are asked to provide the data, but there's not necessarily hard penalties. And it also applies very specifically to a few ring-fenced materials, most prominently things like steel and cement and others. I think that there are going to be two evolutions in this that will impact many companies in other sectors. One is that CBAM will capture other materials as well, because the logic and the principle is that Europe wants to prevent companies offshoring emissions. They want to prevent you just moving your purchasing out of the EU and having the emissions generated elsewhere. And there's a really strong economic reason for that. It has nothing to do with sustainability per se. The reason is if companies start doing that, more and more business activity moves outside Europe, and there's a bigger impact on job creation. And so actually it is in the interest of the EU over time to expand coverage of CBAM to as many materials as possible that they think have a risk of being offshored to make sure that that doesn't provide an economic threat to the trade bloc. The second is that I do expect that all the companies paying these sorts of fees upstream will start passing down those costs into the cost of doing business downstream. And in the case of fertilizer, I expect we will see that in a few years to come. Thank you for a really rich set of questions. This is fantastic. I appreciate we're also at time, a couple of minutes over time, so pretty closely done. But just wanted to say again, if you found any of this stuff interesting, please feel free to check out the guide. Ilya shared the link in the comments. It's also up here in a QR code format if that's easier. Have a listen to the podcast. And then the other episode I mentioned with Mondelez is coming up soon. And so you'll get that in the next couple of weeks. And obviously more of this sort of stuff in any of the content that we produce. So big thank you to everyone for joining. Really enjoyed having you. Please feel free to reach out if you have any questions around this sort of content as well. But thank you very much and have a great rest of the day.